vibration that led success so high. I will achieve, I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Although the HDFC Bank merger is still more than a year away, the two entities are trying their best to streamline as many processes as possible to receive RBI's clearance. A few days ago, HDFC Bank asked its parent company HDFC to cut exposure to some loans that RBI doesn't allow banks to make. The current value of such loans, either corporate loans or loans to developers, may be around 20 to 25,000 crore rupees. Good morning, my name is Ishan Gera and I welcome you to the Business Standard Banking Show. Today's episode will cover the important banking developments of the week. We have an interview lined up with JP Chase India's CEO and MD Madhav Kalyan. In our Banking for You section, our experts explain linking UPI with RuPay credit cards. Moreover, our banking expert Tamal Bandyopadhyay sheds light on the rising repo rate and its impact on consumers and banks. But first, here's a look at the important developments of the week. As soon as the Reserve Bank of India announced a 50 basis points rate hike, it set the banks and NBFCs in motion to institute a series of rate increases. HDFC increased its interest rate on home loans by another 50 basis points. It has now raised rates by 90 basis points in a month. ICICI Bank, Bank of Baroda, RBL and Federal Bank have also increased rates. But it's not just the lending rates that are rising, deposit rates are also rising. TBS Bank and Central Bank of India have hiked fixed deposit rates from 10 basis points to 50 basis points across tenors. Regarding banks deciding on rate increases, Yes Bank's board took a big decision last week to exit the reconstruction scheme. The board recommended to its shareholders that a new board of directors be put in place. The RBI appointed board had taken charge of the bank nearly 2 years ago to arrest a run on the bank. The bank had also improved its capital to risk-weighted asset ratio since then. However, the announcement did not receive much response from the shareholders regarding stock price movement. Investors will still be in a wait-and-watch mode before deciding the future course of action. Moving from banking to insurance, the government announced an increase in premiums for its two flagship insurance schemes, Pradhan Mantri Jeevan Jyoti Bima Yojana and Pradhan Mantri Suraksha Bima Yojana. The premium for the life insurance scheme PMJJBY, which offers a cover of 2 lakh rupees, was raised from 330 rupees to 436 rupees, whereas the premium for accident insurance was hiked from 12 rupees to 20 rupees. The life insurance scheme had 64.1 million subscribers and the accident insurance had 220 million at the end of last financial year. One of the reasons for increase in premiums was that claims were higher than the amount collected under both the schemes. From government decisions, let's move back to RBI's announcements. Along with its rates decision, RBI announced a revision of limits for housing loans given by cooperative banks. RBI Governor Shaktikanta Das, while doubling limits, said that rural cooperative banks that have a net worth of 100 crore rupees and above can lend now up to 50 lakh rupees per individual housing loan as against the previous cap of 20 lakh rupees. In contrast, others can give loans up to 75 lakh rupees. Urban cooperative banks can lend up to 1.4 crore rupees. The move is expected to further increase access to affordable housing. From UCBs, we now move on to foreign entities. JP Morgan has had a long history in India. 2 decades ago, it started its global service center in Mumbai. Business Standard's Raghu Mohan had a conversation with JP Chase India's CEO and MD Madhav Kalyan on how India, especially financial institutions, are recovering post-pandemic.
Welcome to the BS Banking Show, Mr. Kalyan. Good to have you on our show. Now, my first question is, what's your view on health of India at this point in time, a good 2.5 years after the onset of the pandemic?
Thank you, Raghu. Thank you for having me on the show. Such a pleasure to be here. As India emerges from the pandemic and with the robust rebound of GDP, what we are seeing is corporate India has used this period to deleverage, is in its best financial health. And I'd say this both for corporates and for our financial institutions as well. As we talk to clients at this point, Raghu, we see 4 priorities. One, to make the best of the it's a growth mindset that we see, and people are focused on the significant upside opportunities that come from the post-pandemic rebound, and that's something that we are seeing. Second is it is the volatility that got caused because of the pandemic and then the war is unprecedented. So navigating volatility is another key focus that we see with corporate India and with our clients. The pandemic clearly has accelerated innovation, scaled innovation, and scaled digital innovation. And so we're clearly seeing clients focusing on building direct to customer digital solutions, and that's an area again we are seeing as a big priority with clients. The fourth area of priority that we see is around leading with an ESG mindset. The question that most clients, when we have strategic conversations with them, ask us is even as we make the transition to advance our sustainability agenda and we move towards our diversity goals, picking partners that work on these areas.
Can you give us a sense of the stratification of the stress levels in the industry? I mean, in the sense that if you were to give a hierarchy of sweet spots and pain spots, how do you see it?
So sweet spots, I would clearly say our banking system is in a place where it can, where a lot of the legacy issues have been cleaned up, balance sheets are as strong as they can be, and they are in a position where they are able to help industry sustain the next wave of capex that will come with it. Industry itself, the large players, we are clearly seeing have debt equity ratios are at their lowest. People have really deleveraged their balance sheets, took advantage of the low to near zero cost interest rate environment globally to deleverage balance sheets, to reduce interest costs and improve profitability. So large corporates clearly doing well. SME and MSME has been the area that's taken a hit, and that's where we've seen the government step in with the emergency credit guarantee scheme, supporting the job formation. That's the area that all of us will need to collectively focus to work on. Consumer is coming back. There has been a loss of jobs. Discretionary spending has been controlled. Inflation is coming back, and so consumer is still a wait and watch area.
Now, coming back to the foreign banking turf, coming back to the foreign banking turf, just about every foreign bank today is a wholesale stroke institutional investment bank. There are just two full services banks left. Now, is this niche getting a bit crowded?
Not really, Raghu. The interest in India is unprecedented at this point in time. And the foreign banks that we have in the country represent international players. And these could be institutional investors, these could be financial institutions, these could be MNCs from different markets. A set of banks will focus on institutional clients, accessing both India's debt and equity markets, bringing in the largest MNCs that are trying to harness the opportunities that Atmanirbhar presents, Make in India present, and the PLI schemes present. So there are people catering to this renewed interest in India and the growth story that India represents, and it needs as many foreign banks from as many regions to be able to bridge that build the bridge between the two countries, cross-border trade, cross-border payments, constituents from each country which they understand best. So I think while everyone is in corporate banking, if you peel the onion, everyone is serving a different set of customers and bringing a lot of value to the country collectively. The US is the largest economy in the world, accounts for 40% of the global market cap. And so the opportunities that get created can't be serviced by any one bank. It requires all the large US banks to be present in the market to be able to service these clients and their needs, even as they grow in India.
In terms of inbound investment, do you think there are attractive enough targets in India at this point in time? You see, it has caused a little bit of distress among the large corporate also, whether it will be acquired or not. How do you see the M&A market playing out now, inbound, into India?
We've seen a few transactions that have happened last year, like the Z Sony transaction. For example, inbound, we see in the M&A space, we see a lot of interesting assets that are available. And with the market corrections at this point in time, valuations also do make sense. The large players, and there is a consolidation play. The Tatas have done transactions. As you saw today, we've had the large cement transaction where we were advising on the sell side. We were the exclusive financial advisor on the transaction there. So there are multiple transactions that are there. There are value creating opportunities that come out of consolidation, and the M&A space, given where valuation is and the kind of assets that are available with strategic players, I think there will be interest. Last year we saw SMBC come into Fullerton. We saw Z come into Z and Sony work together and create a partnership. India has always been a very friendly M&A market, and it's not a hostile market. It's always a combination, a market that works in consolidation and creating larger entities. So that will continue.
How do you see the market for cross-border commercial borrowings? In January, a Reserve Bank of India paper say that 63% of the borrowed amount should be hedged. And given the volatility that you're going to see going ahead, how do you view this?
So typically what happens is the foreign currency loan markets begin to take off when bond markets become very volatile, as is the case right now. Last year, there were over 30 issuances in the bond markets. This year, we've seen only 5 or 6. So clearly, these are volatile times, and international debt capital markets are asking for larger values than our clients are willing to pay, which is when the international loan markets take off in a significant manner. Even as the government spends in capex and corporate India is following suit, definitely we see capex happening in cement, we see capex in steel, we see capex in non-ferrous metals, we see renewable space continue to invest and grow. So even as all of that happens, we will see the syndicated foreign currency loan market continue to grow. Now, the question of hedging is bespoke. While RBI has a general guidance based on the overall industry and their amount of hedging and unhedged foreign currency exposures at an aggregate level, each player will have, some of them are exporters, they will have natural hedges, so they can hedge much lesser. Others, like players in the renewable industry or say a state-owned entity where its revenue flows are all local, will need to have more conservative hedging programs. So on an aggregate, that will be that number which RBI came out with does make sense. But individually, there may be some that can run currency risk because they have a natural hedge, and others who will do it in a different way. Also, we are talking about interest rates going up. So while one borrows in international markets, very quickly we will probably see a cycle of interest rate increases in the US. So interest rate hedging and risk management on the interest rate will also become important, which was not the case for much of the last decade. You needed to focus on currency only and not so much on interest rate hedging. But that becomes important as well.
JP Morgan has just completed about 75 odd years in India. How do you look back at the journey so far, and can you still place a decade into the future?
For us, we continue to invest as our chairman Jamie Dimon says. We go into countries with a several hundred year view, and we've continued to invest in the country. The amount of capital that we put here, the number of people that we have, the cities we operate in have continued to grow. We will continue to follow the same path. We serve broadly 4 sets of clients. We serve MNCs and we help them, you know, realize the potential of the Indian market, help them go deeper into the Indian market with a range of solutions. We work with Indian companies that need our international platform. We'll continue to do that and we'll deepen and Indian companies are becoming global champions and we'll continue to help harness that opportunity for them. We will continue to be the premier bank for financial institutions in managing their cross-border flows, their payments. We will continue to invest in that as an area. We are doing a lot of work with foreign portfolio investors that need to access India's growing and ever-growing equity and debt markets. And that is significant work that we continue to do. Over the last 3 years, we've started our commercial banking business, and we believe that business will scale significantly. We'll continue to deepen, continue to invest, Raghu, in India, and we're very committed to the market.
Mr. Kalyan, it was good to have you on the show. Look forward to connecting with you again. Have a good day.
Thank you so much, Raghu.
Kalyan says scale digital innovations and sustainability are big priority areas coming out of the pandemic, and consumers are coming back. Another transformation that has been taking place in the banking industry is the fast movement towards digitization of payments. Last week, RBI announced linking RuPay credit cards with UPI. Our experts explain how this would work and what the concerns are regarding charges.
Until now, you could use India's flagship payments platform, Unified Payments Interface, only as a Pay Now facility. Money was debited from your savings bank or current account, which was directly linked to UPI. But soon, credit facility could also be enabled on the UPI platform through linking of RuPay credit cards. In its June monetary policy review, the Reserve Bank of India announced that it would allow linking of RuPay credit cards to further deepen UPI's reach and usage. But there is one issue. The central bank did not give details of the pricing structure. At present, UPI and credit cards are on opposite merchant discount rate or MDR structures. While there is no MDR for UPI, MDR for debit cards is capped at 0.9%, and there is no cap on MDR for credit cards. Typically, there is an MDR of 200 basis points for non-RuPay credit cards and 50 basis points for debit cards. While there is no MDR for RuPay debit cards, MDR for RuPay credit cards is typically lower than that for Visa or MasterCard credit cards. The industry is now going to hold consultations with the central bank and the National Payments Corporation of India for more clarity on the pricing structure for a successful rollout of this feature. According to brokerage houses, since there is no MDR for UPI through debit cards, if UPI through credit cards attracts an MDR, the uptake of the product would be uncertain beyond the existing merchant base that uses point-of-sale devices and pays MDR on card transactions. However, from a convenience standpoint, it will be a lot easier for consumer to pay through their credit cards by just scanning a QR code rather than carrying the card and swiping it on a POS machine. Further, if the RBI also extends this facility to credit cards issued by other card networks, the acceptance for credit cards could go up, thereby increasing the spends.
I am the blue of the limitless sky. I am the inspiration that led success soar high.
nation's trusted bank, SBI, the banker to every Indian.
Among decisions announced by RBI, including the UPI linking of credit cards, the one that has the most impact on banks and consumers is the rate hike. Our banking expert, Tamal Bandyopadhyay, explains the composition of loans in the industry and how rate hikes will impact consumers and banks alike. Hi Tamal, thanks for coming on the show again.
Thank you.
Now, after RBI's announcement, banks have been raising the rates in a quick succession. And you highlight in your column this time that it is a double whammy for the economy. But what does it mean for the banks themselves? Because as I understand, Treasury would not be of a help either. Are we looking at the worst year of banking after they just had their best year?
No, not exactly, because yes, indeed, the treasury income will be affected, and probably the first quarter, most banks, I would like to believe, will be in losses. In fact, I know, I can't name the banks. I know a couple of banks, large banks, they are in losses in the first quarter. Because the pace of hike has been very rapid. Within a quarter, 90 basis point rate hike, and you can see how the bond market behaved. When the pace is gradual, which we expect to be, I think Treasury is prepared for it. The first hike was, they are not prepared for it. They were expecting a hike in June, but not earlier than that. So, having said that, would the Treasury make the kind of money they made in the last 2 years? They would not. But the Treasury, the loss in Treasury income will be more than compensated by the bank's higher interest income. The so-called net interest margin will be higher, because you see the banks are slow in raising deposits. That's point number one. And even if the deposit rate goes up, it's only applicable to the new deposits. The existing deposits continue to be priced at the old rate. Whereas the loan is an instant transfer. For the floating rate loan, particularly the external benchmark limit. So what is happening is this: your cost of funds not going up as fast as your earnings on those funds going up. So the interest income will be far higher this year, in fact, if you see. So which will compensate for the treasury income. So I don't think it will be a worst year. It will be as good as last year.
Now, this is very interesting because you just talked about the floating rate part. And you highlight somewhere, and it's an interesting calculation that you make, that the 100 rupee loan that was with the SBI, 22 was fixed, 78 was floating. Out of that 78, I think 42 was MCLR, if I'm not mistaken, 35 was ECLR, out of which 23 is repo and 12 is T-bill. Now, where do the MSMEs figure in this calculation?
All MSME, I repeat, all MSME loans are linked to EBLR, and that's a concern. All MSME loans from December 2019. Now, Reserve Bank of India has done it for faster transmission. Because what happening is that was you remember, till 2019, it was a low interest rate regime. But now in a rising interest rate scenario, when the interest is going up and up and up, it will be. Globally, you are seeing that, and we can't be in isolation. So definitely the loan rates will go up and MSMEs will be hit hard. It will have an impact on the demand. So which means it will have an impact on the growth, GDP growth. And also it will have an impact on the bank balance sheet. Probably the default rate will rise. It's also a question of, I should not be a Cassandra, but financial sector stability. We need to wait, see the RBI FSR report, which is...
Now, it's very interesting because you talk about this. We are talking about the MSME side. Let's talk about the consumers. How will the rate increases work for the consumers? Will their tenure change, or how much they're paying? Because the common man is very worried about this thing.
No, you know this, for instance, if I have taken a loan and say I have an EMI of $1,000. Okay. Now, typically banks try to stretch the tenure, not my EMI quantum, and I think they have some age in mind. Suppose, depending on the age, if he says that if the tenure goes beyond 75 years, I am more than 75. In that case, they will not stretch the tenure. They will raise the interest rate, the EMI. And for NBFCs like say HDFC, as a home finance company, home loan company, I think they have their, what is the maximum tenure of a loan can be? Is it 20 years or 25 years? And if it says they're stretching the EMI to that extent, covers up within that period, it's fine with it.
Now, I'm taking you a bit away from your banker's trust this week to an issue that has arisen, now, and that is the Insolvency and Bankruptcy Code. Now, although its performance has been better, it is still not what the government expected. Its debt resolution has slackened over the last 2 years, and most of the companies that are there, I think 47%, if I'm not mistaken, are in liquidation. How can the government restructure it or make it more effective, according to you?
Well, you have touched a raw nerve. Actually, this is a problem. We have not been doing well, but it's too early to write it off because remember it came into being in August 2016, and it's a record time. And you also need to compare it globally. So, and it has been fraught with a lot of litigations and various things and all. But and then of course we are seeing in some cases, the backdoor, the promoters tried to get into the backdoor entry, etc.
Yes.
It's a very complex issue. Again, we are in some sense we are unfair to promoters, and particularly to those who are not willful defaulters. For external reasons, my business has collapsed. So why shouldn't I be allowed to come back and bid for myself? I mean, globally, promoters are never treated this way. You see, we treat them like lepers in the previous century in a village. You become an outcast. So yes, indeed, there are rogue promoters. So that's one aspect we need to look into this. And yet another aspect, most important part is this. You have to see when an asset is sold, what is the enterprise value? There are certain kind of assets which have no value, which absolutely have no value. So you can't expect more than 5 or 10 or 15%. This thing and all. And that brings to the third and most important part of it. I mean, we go on. How do we auction it? The Swiss challenge method and all sorts of things. But nobody talks about asset preservation. Globally, part of the insolvency also the asset preservation. Here we don't have any asset preservation. So if I have a plant, I just put some securities that the instruments are not stolen, but it gets junked over a period of time, and there is no norm within the IBC for asset preservation.
Thank you. Thanks a lot for your time this week. We hope to see you again next week. Thank you.
Thanks.
Tamal says the IBC is a complex process and it's too early to write it off. He also said that India needs to be cognizant of enterprise value and asset preservation. That's all for this week. We'll be back next Thursday at 11 a.m. with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.